Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the financial sector. Two major players, IIFL Finance and SP Group, are making headlines with their fundraising efforts. Let's start with IIFL Finance, which is set to raise up to $750 million through external commercial borrowings and dollar bonds. This move is expected to provide a significant boost to the company's liquidity and help it navigate the current market conditions. On the other hand, SP Group is planning to raise approximately 25,000 crore through a bond issue, with about 15,000 to 16,000 crore coming from the domestic market and the rest from overseas investors. This fundraising effort is expected to have a lower pricing than previous borrowings, thanks to improved prospects for asset sales and a potential settlement regarding its stake in Tata Sons. The SP Group's plans to monetize its stake in Tata Sons have enhanced recovery visibility for lenders and bondholders, making this bond issue more attractive to investors. With investor appetite appearing strong, it will be interesting to see how these fundraising efforts play out and what impact they will have on the market. As we continue to monitor these developments, it's essential to remember that investing in the stock market always involves some level of risk. It's crucial to do your research, set clear goals, and diversify your portfolio to minimize potential losses. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of tech and finance, where Nvidia's latest earnings report has sparked a lot of interest. The company's CEO, Jensen Huang, spent a significant amount of time justifying the massive capital expenditures committed by major AI hyperscalers like Amazon, Alphabet, Meta, and Microsoft. He argued that compute equals revenues, suggesting that the more complex AI models become, the more computing power and time they require, leading to increased demand for Nvidia's products. However, some experts are questioning whether these huge investments will actually translate into real productivity gains and revenue returns for enterprises. A recent survey found that despite 70% of firms employing AI, over 80% reported no impact on employment or productivity. This raises concerns about a potential AI bubble, where companies are investing heavily in technology without seeing tangible results. Huang also addressed rumors of a falling out with OpenAI, praising the company's offerings, but revealing that a previously announced $100 billion investment is still not finalized. Additionally, Nvidia's relationship with China remains uncertain, as the company awaits approval to ship its H200 chips to the country after a long-standing ban. It's clear that Nvidia is bullish on the future of AI, but the market seems to be taking a more cautious approach. Despite exceeding revenue expectations, Nvidia's shares only saw minimal gains after the earnings report. As we continue to navigate the complex world of tech and finance, it's essential to consider multiple perspectives and evaluate the risks and potential rewards. Welcome back to the Riskwiser Zone. Today, we've been exploring various aspects of risk management and investment strategies. As we wrap up this episode, let's take a look at an interesting development in the world of credit card spending. According to recent data from the Reserve Bank of India, credit card expenditure in January moderated from the festival-led highs in December. Indians spent approximately Rs 199 lakh crore through credit lines offered by their banks, which is down from Rs 2.05 lakh crore in the previous month, but higher than the Rs 1.82 lakh crore spent last January. This moderation in growth rate indicates a normalization of spending patterns after the festive season surge. The number of active cards rose to 106.6 million, with net new additions slowing to 868,000 compared to over 900,000 in December 2025. Large private banks continued to drive incremental card additions, while public sector banks gradually expanded their share of credit card spending. It's worth noting that the slower pace of additions reflects tighter underwriting standards and regulatory discipline around unsecured lending. Industry experts expect growth to remain calibrated, with issuers focusing on portfolio quality, activation levels, and fee-based income rather than aggressive expansion. As we analyze this trend, it's essential to consider the broader implications for consumers, banks, and the economy as a whole. While credit card spending can be an indicator of consumer confidence and economic activity, it's crucial to maintain a balanced approach to lending and borrowing. In conclusion, the moderation in credit card spending growth serves as a reminder of the importance of prudent risk management and responsible financial practices. As investors and consumers, it's vital to stay informed and adapt to changing market conditions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.